Good morning, everybody. Camden, I see you're here. Is everything working on your end? If we can get started.
I believe so. Can you hear me okay?
Yes, awesome.
Okay.
Well,
And if
everyone,
Renee, I want to make sure Renee is on as well.
okay,
I'm
Let's
here.
see. Oh yeah, he is on. Okay. Yep, Renee's there too. Perfect. Yep, we're
awesome.
good.
Thanks, Camden. Well, good morning, everybody. My name is Nico Nicolau. I chair the Education Committee on the Eastern Board. And we definitely have been talking for the last couple of weeks of feedback from our members from Inspire, all the way to now about the
Oh,
tariffs
goodness.
and some of the elements with them. So we have Camden here from Invesco and Renee, part of their firm, to kind of walk us through what they're seeing in the industry and also how this can impact us. So I'm going to turn it over to Camden and let us take it over the presentation.
Yeah, thanks, Nico. Yeah, so name is Cam Cowden with Invesco, and I'm a market leader, which I work with financial advisors and kind of consult financial advisors in Tennessee and Northern Alabama. I'm based out of the Nashville area. And so in Invesco, we run around 1.7 trillion in client assets, and ETFs or exchange traded funds are a big part of that. And so we're fortunate to have with us today Renee Reina, who's Invesco's head of thematic ETFs, and he is a strategist on our leisure and entertainment ETF. And so he's a great resource, has really good perspective on what's going on in the markets, and of course in that specific sector as well. So what he's going to do is just give a brief overview of kind of some of the companies that are in that ETF, but more importantly, obviously tariffs are on everybody's mind. It is kind of the topic of the day for good reason. So he'll be able to give some nuts and bolts on tariffs in general, some of the effects on the specifics in the entertainment industry as well. And then, of course, we'd be glad to take any questions along the way as well. But again, appreciate you having us join. And Renee, the floor is yours. Thank you.
Perfect. Hello, everyone, and appreciate the opportunity to join you today. As mentioned, so I'm head of our thematic ETF product line. So I cover a wide range of our ETFs and help our clients sort of navigate some of the exposures, digest what's happening in the economy. One of our ETFs we offer is our Invesco Leisure and Entertainment ETF. The ticker on that is PEJ. And what this ETF does is it's a basket of 30 stocks of U.S. leisure and entertainment companies. So think about it sort of two parts. You kind of have hospitality industry, so hotels, restaurants, bars, cruise lines, casinos, other sort of recreation and amusement businesses. Then you have sort of entertainment programming. So this would be like production of motion pictures, music by recording artists, radio, television, including pro sports teams as an example. The portfolio is basically weighted towards larger components of this cohort of companies. So about 60% of the companies are going to be sort of more larger cap in nature. So it'll be about five. So 8 companies, about 5% weighting of those companies. And then the remaining 22 companies, on average, going to be about 2.37%. And that's going to be sort of the smaller mid-sized companies. This ETF has been around since 2005 and actually launched in June 2005. So it's been around. It's going to be a 20-year anniversary here in June. The fund right now sits a little over 300 million in assets. And I guess when we look at this particular fund, and maybe just a couple of things to point out, give you an idea of the types of exposures, but I look company by company level. So right now, the portfolio as it stands, the largest percentage of holdings fall in that sort of restaurant component. So think more retail. You're going to have e-commerce. So think of like DoorDash, for example. We have cruise lines currently in the portfolio about 14%. I'm sorry, 12%. Airlines are about 11%. We have about 10% in hotels. Internet gambling and gaming, you're going to see around 15%. And so just kind of give you a sense of how the portfolio exists today. There's a process for security selection where it's a multi-factor approach where various factors are used to determine what goes in the portfolio. So every single quarter, this process takes place, and the securities within these industries are ranked, and that's how you sort of make it in the portfolio. So you got to get top ranked. Every quarter it reconstitutes and rebalances, and so what we see over time is companies that are having strong momentum, strong earnings growth, relative to other companies within this sort of segment, get into the portfolio. So an example of that would be, think about post-COVID, where the economy started opening up and we started to see recovery in cruise lines and airlines. We started to see higher allocations there. Over time, we've seen online gaming, for example, I think DraftKings, where this increase of micro betting has increased, and then the AI capabilities around trying to interact and engage with their customers, increasing revenue. So we've seen over time this evolution of new names kind of coming to the portfolio and older names sort of on the bench. So, I think an example there, if I just look at, today, from internet gambling, for example, DraftKings was pulled out last year. Sports Trader Super Group is in the portfolio. From a professional sports standpoint, TKO Holdings is in the portfolio. It wasn't in there this time last year. So that's the company that owns WWE and UFC. You see Madison Square Garden Sports, so the company that owns the Rangers, the Knicks, in the portfolio. Disney kind of comes in and out. So just kind of giving an example of the exposures that are in this type of portfolio. What we've seen right now, or at least what we've seen on a year-to-date basis, we just think about the impact of tariffs, is it has influenced performance. And so I think when we look at this particular space, what we try to do is assess what are the impacts. And so the tariffs, as you know, are basically an increase or a tax on the business owner. So if you're going to continue to import for certain countries based on where the import threshold is today, you will then pay that fee. That goes to U.S. Customs. That's sort of the revenue component. You think about President's comments of trying to increase revenue for the U.S., and then each company has a decision to make. Do I pass on that additional cost to the consumer? Do I find another distributor, perhaps here in the U.S. or in another country that has more favorable tariff rates? And that's effectively what every company is trying to understand and assess right now. As this takes place in the marketplace, we're seeing very increased volatility. And I think a lot of that is predicated around these unknowns. And as these unknowns happen, when we look at the market, we see certain segments, these tariff risks start to get priced in. So we think about the markets today, for example, we've seen, at least here in the U.S. specifically, a lot of companies start trading down in value. So think of like the AI companies, where we've seen companies like NVIDIA, Microsoft, sort of that theme sell off. But then we come to the companies that we want to talk about today, entertainment and leisure, and we start trying to understand where their exposures are. The biggest threat, I think, right now to these types of companies is probably the most obvious. So there's a consumer element to this. And if we look at consumer sentiment, it's at a level that you'd have to go back to a global financial crisis era to get a sense of where consumer sentiment is. University of Michigan does these surveys on a monthly basis. These are usually good indicators for us to understand what the consumer is thinking or feeling. And we've seen 4 straight months of reduced sort of survey results. And if we compare April to March, for example, April is down another 11% compared to March. So we know the consumer is seeing what's happening as a little bit sort of doom and gloom, as we kind of wait and see. We all know that when we look at entertainment type industries and companies, this generally comes from discretionary income. So the idea is that perhaps a lot of the population is starting to hold off a little bit. We're not seeing that quite in the data yet, other than these sort of survey results. And these are the areas that we're monitoring. I think the good news, if we look at this particular space prior to this year, these companies were doing really well. And a lot of the talk was around this sort of post-COVID recovery. So again, think more airlines, cruise lines had a very good quarter. If we look at Q1 results, so Royal Caribbean, Carnival Cruise, for example, the airlines, United just posted results. And so, very positive to the consumer in terms of spending. And then we look at some of these other industries, the hotel industry, for example, casinos, they were generally growing. In fact, if I look at this ETF, it was up, 24% last year in 2024. So fast forward to today, as we try to assess what's happening, we try to look at where the companies or where the industries that have the most exposure to these tariffs. And I think the good news is there are segments that have sort of built-in defense, if you will. So I'll start kind of with the pro teams. We see a lot of these US-based companies that have these longer-term contracts. They seem to be a little bit better insulated, so less exposure to the international consumer. And so we see certain areas that are somewhat insulated. And we start looking company by company or industry by industry, we can start seeing where the market is pricing in some of the biggest drags. And so, for example, I mentioned the name DoorDash earlier. There's a company that is better insulated to tariffs. If we look at restaurants as an example too, so restaurants have generally continued to grow slightly on a year-over-year basis. They've generally passed on cost to consumers. So inflation was a big topic we were talking about last year, and they still seem relatively insulated at this point. DoorDash, a big partner with a lot of restaurants, also seems somewhat insulated. So those are areas of the marketplace where we still kind of see, just based on sell-offs in the market, holding up a lot better. It's really some of these areas where you have the international threat in terms of travel, tourism, that are going to be impacted. So I mentioned sort of movie production, think Warner Brothers, there's an area where I know China is, it's gone on to say that they'll refuse to show US movies within their theaters. So that puts a threat to revenue sources there. We're also seeing certain areas within gaming or gambling. And so these would be more for your diversified casinos that have exposure to China, for example. And then there's the airlines and cruise line component to where really trying to track what's happening with the consumer. From a supply chain perspective, I think that's another area where the more exposure you have to China specifically, I think is where some of the biggest threats are. I would say, generally speaking, since this fund in the area of the market that I cover tends to be more US, tends to be a little bit more insulated. So we kind of look at it more large companies versus small companies. And as tariffs get announced and as rates still sort of remain high, sort of your larger companies seem to be holding up better than your smaller ones. So there's small cap, mid cap type companies are starting to get discounted or sort of repriced. We think this could potentially create an opportunity, at least from a discounted valuation perspective, relative to these large companies. I'll just make one more comment and I'll stop there and open up to any questions. And we sort of look at it as sort of base case, bull case, bear case. The base case is most of the tariff impacts are getting priced in. And so companies are making decisions. In some cases, they're spending more money today, so they're trying to get in front of these tariffs, pull in inventories. which throws off some of the data as we try to really assess what's happening with the economy. But I think the base case can be that there's just a lot more posturing than the desire to have the economy go into a recession, and we'll sort of start little by little stabilizing, and the consumer will start feeling better. The bull case would be that multiple countries are responding positively to these tariffs, and you start seeing an impact from revenue. We continue to see growing wages, and the consumer starts to feel healthy and continues to spend, and perhaps there's some pent-up demand as they were kind of taking this wait and see approach. This can kind of prop up some of these companies, specifically into the entertainment business. I think the bear case would be tensions with China continue. We continue to see new data supporting that GDP is declining, consumer sentiment continues to decline, employment continues to decline, and we can end up in sort of a recessionary type environment. So those are sort of the areas that we're monitoring. I'll stop there though to answer any questions.
Looks like there is a question. Renee, do you hear chatter or see policy statements by the U.S. or China that would indicate tariffs would be extended to include services?
So services being the majority, sort of where our, if you think about the U.S., we've become a service economy. At this point, if we just think through, or at least what we're observing in terms of extending 90 days and making concessions to some degree, we don't believe at this point that would be the case. I think it's almost becoming more of a tit for tat with China, and so we believe that both President Xi and President Trump, at this point, want to come to a resolution. I mean, we see signs and signals, for example, of both America and China kind of stating where they would, what they'd like to see next. So, for example, China saying we want more respect, we want a dedicated sort of point person with the U.S. To us, that signals that they're willing to negotiate. Everyone's sort of setting these new parameters. So we're probably more in a base case scenario where we're just trying to get a good sense of where China and U.S. relations sort of end. But it is a little bit early to tell. But
Yep.
Our view at this point is not.
And it's funny because I see a bunch of there's like Anthony Pruitt's in here, Rob Palmer's in here, Stephen Young is in here. All these.
So it looks like there's, let's see, a couple more.
Anthony's in there.
See, there have been signs tourists from Canada and Europe are changing plans to avoid travel to US in 25. Are you including that in your predictions as another one?
Yeah, so when we look at, various surveys that come out. The Tourism Economic Survey, it's done in Philadelphia, came out. I think their projection recently was a 5% decrease in international travel in the US, a 15% decline from Canada. So that's what, at least that's what we're starting to see a little bit of drop in some of that activity, but it hasn't been meaningful yet. And so when we look at, I guess, kind of going back to some of these companies that I mentioned, bookings, for example, they're kind of done a little bit in advance. And so as we listen to earnings calls and reports, airlines, cruise lines, although they recognize that there is some threats there, they're not seeing meaningful decline quite yet. But yes, to those points there, those are big factors. And, for example, we'll look at hotels and try and get a sense, Hilton, Marriott, what percent of their business and revenue is coming from the international markets. Now, there's a little bit of difference there in the hotel industry because although, we kind of think of it twofold. So one would be US revenue generated from Hilton or Marriott, but they still may benefit as their customers are traveling internationally, but just not in the US. So, part of it is trying to figure out how to price in what those impacts are and understanding the consumer base, what is, who has a high percentage of a Canadian business, for example, which in the US, a big percentage of our international travel does come from Canada. So yes, that is factored in. But at this point, as we listen to, like I said, many of these earnings calls, we're not quite seeing it yet. We're hearing anecdotally that there's going to be a decline and starting to sort of assess what that is. And I think the market is pricing that in. So if we look at where it is today, I think what we're trying to understand is there new news that we're missing? So if we look at companies as they're priced in the market, so think about how far some of these have fallen since the start of the year, it does appear that that's getting priced in right now. But I will point out, like, there are still these businesses that have a wider moat. TKO is a prime example where, WWE, UFC, these are, their contract actually ends, I think, this month. And so they might sell, $1 billion contract for access to Netflix, to Amazon. That fan base tends to be loyal. You look at the sports industry, tends to be loyal. We look at the gaming and gambling industry. This was one of the biggest quarters ever. We think about gaming, and a lot of that is a lot of those micro bets that are occurring. So I think there's parts of the leisure entertainment business or industries that are better insulated, and there's others that have a bigger threats if they have a lot of Canadian or international customer exposure.
Okay, there's one. Can you elaborate on comments you made about U.S. gaming entities in China? Did I hear that right?
Yeah. So, if you think about so I guess I'll just go into our portfolio today.
So probably the DraftKings and things like that is what he was talking about, U.S. gaming entities and
Well, and
having
and
access to China.
Yeah, a lot of it too is we've had. I mentioned the quarter by quarter rotation or reconstitution that happens in the portfolio. So, for example, if I just look at the last 5 years, we've kind of went in and out of owning MGM Resorts, Caesars Entertainment, Wynn Resorts, Las Vegas Sands Corp. So it's a little bit of having some China exposure versus not. I guess my point really there was, in some cases, some of these casinos rely heavily on some of the revenues are on international travel, specifically the Chinese markets. So I think there's a potential impact there, kind of going back to reduced travel. And in some cases, they're diversified region by region, similar to hotels, where although it could be a threat here in the U.S., they may offset that by their consumer base sort of regionally, if you think about it that way. So it's just more of a comment on sort of the nuance around some of these international components and the customer base, company by company.
And let's see, it looks like TEA depends on owners and operators investing in their physical assets, such as building new locations, experiences, and renovations of existing properties to drive visitors to additional revenue. Have you seen any indicators about companies changing the rate in which they are investing in projects?
So on the sort of, I consider that more kind of like the REIT side of the house. I haven't noticed any trends there. Admittedly, I think a lot of our research and analysis has just been on kind of understanding more of the consumer base. So again, think more of the subscriptions, the bookings. When it comes to the buildings, I know here in the US, it seems like there's been a little bit of slowdown, sort of broadly speaking, but when it comes to entertainment and leisure companies, I don't know that answer.
Yeah, I think it's essentially around like, are you starting to see companies kind of spend less in anticipation of the tariffs? And I think it does seem like you're seeing a little bit of that. Oh, can't share. And I was going to mention too, I'll send over, I'm not able to share, but we do have a really good, it's called Trending Conversations on tariffs. Everything you need to know about tariffs is what it's called. And so it does break down, what would have the biggest impact as far as tariffs go, which would be pharmaceuticals, automobiles, some of the apparel, hospital services. It'll show some of the historical perspective through what happened with our last trade war with China as well, going back into 18 and 19, and a little bit of some kind of specifics on tariffs in general. So I'll make sure and get that out to Nico that he can distribute. So you all have that as well.
I would maybe make just one more comment too. I saw the last one we've heard from our UK clients. There's a lot of boycotts on US products in the UK. That's one thing, it is. So we're a global organization. So multiple times when it calls with our, colleagues from the UK, and that sentiment is accurate and it's true. And I think that's the one thing that we're, at this point, really just trying to understand and assess how, where is, use sort of the president's comment with his conversation with Zelensky, sort of who has the cards. And I think that's the part like we're trying to assess right now. We're a global society intertwined in a lot of different ways. And, in many cases, these multinational companies have revenue sources coming from all over the place. And although, yes, there may be a boycott to a US product, that might represent less than 1% of revenue. And I think this is a part where, does this become a bigger trend? Are we seeing a reshaping? I think people are probably saying yes in terms of globalization, how we move forward with our trading partners. But the one part that keeps coming back is that we're starting at a very aggressive point and then slowly kind of working our way back. And these pauses are demonstrating at least that maybe there is another goal here. Perhaps we're not seeing, or perhaps just buying some time that we can find sort of an amicable agreement sort of with our trading partners. But the sentiment that you're talking about is real. I mean, we see it all over the place. And that's where we're really just trying to assess. The other part of throwing things off is, again, I mentioned earlier, a lot of companies are just getting ahead of this and trying to put in all their orders. So when we look at data, we're going to see almost like an increase, like spendings continue to improve. And you might scratch your head and say, okay, well, I'm hearing anecdotally all these different boycotts and challenges. We're just not seeing it. There's this lag. And so we'll start seeing an impact, or start getting a better sense of what the impact is. Hopefully, if it is having a meaningful impact, at that same time, we're starting to see relations globally improve. And that's sort of like the wait and see component of it all.
Yeah, and I was going to mention to the one question about essentially business expenditures freezing. That's going to be part of what I send, but that is what we saw in 2018. Was there was about a 40% drop in capital expenditures from businesses during that China trade war, during at least that first, call it 6 months, until we had the clarity. And then if you remember what happened, there was the pause, and then China, the deal with China phase one started. And then from there, you started to see capital expenditures ramp right back up and go to actually past historical norms. So I think that's the tough thing, is there's not a lot of clarity right now. The market did not have priced in the April 2nd numbers. They quickly priced those in. Then there was a pause, which means, are things getting better or worse. And it does seem like that with the pause does seem, as Renee said, there's some at least there's some ability to negotiate. There's some willingness to negotiate. So tariffs can get better from here. And then from what it seems like, too, you have the, you know, China is again the big one, just like it was in 2018-19. And that took, you know, several months to sort itself out. But the market likes clarity. I know your companies like clarity. That's what, you know, hopefully we'll get more clarity over the coming months. And then we'll have a similar cadence to what happened in 2018-19 once we get the clarity. Let's see, were there any other some chatter on some of the kind of travel changes? Anything else that anybody can think of top of mind that we maybe did not touch on as far as tariffs go, or leisure and entertainment in general? Okay, I think should be in pretty good shape, it looks like. And yeah, as things change, we put out blogs, we put out thought leadership as as the environment changes on tariffs. So I think, you know, we'll keep an eye on that. We'll certainly have some more info available, but it will certainly be interesting an interesting several months as these negotiations with other companies happen. And could be a totally different environment 6 months from now if we have, you know, positive movement on the negotiations too. All right. So you think is that about all the questions, Nico, you think?
I think there was a question regarding IP overseas. You mentioned showing
Oh,
films, but a lot of big international developments rely on IPs to differentiate them. Do you see any possible reduction in that demand?
oh, I see it. I missed that. Yeah. Renee, any comments there? It says you mentioned some markets won't be showing films, but a lot of big international developments rely on US IPs to differentiate them. Do we see any possible reduction in demand there? And then on the home front, tariffs will impact importing goods that are vital to theme parks. Any thoughts on those two?
Yeah, so I would some of the first part I would say is, you know, this comes down to like the retaliatory components of this all. And I think that's the part where we'll see how you know, if I just use AI as an example or semiconductors as an example. So, you know, we put a ban on China using semiconductors. What China decided to do was try to be a little more resourceful, and they even have desires to sort of create their own, so eliminate the reliance on US semiconductors in total. And then we're finding the marketplace kind of doing the same thing. Like, how do we reduce, and this is kind of what's all happening, reduce reliance on others is kind of one way to think about it. So yes, I think that there are some, you know, there are some threats there, and it's just I think part of it is retaliation. The other part is there a threat to some of the service business side, IP side in the US because of what's sort of happening. And that's, you know, it's too early to tell, but I think that's one other concern. And then when it comes to impacting imported goods from vital to theme parks, yeah, absolutely. I mean, you know, in many cases, so there's multiple parts to that. So like we look at some of these, you know, food distribution companies. So an example, I'm trying to just find in the portfolio, I think we have Cisco. You know, they're more insulated. So most of their purchases are here in the US. So not a lot of threat there. The theme park, though, goes beyond that. This is kind of where it'd be interesting to see where the president lands on what's going to be sort of new tariffs around electronics, semiconductors, including the pharmaceuticals. We know that theme parks are becoming more technological advanced. So this is kind of where the consumer experience is changing and evolving. Think about a new Disney sort of ride or entertainment sort of. Trying to think what they generally call their experiences there. But yes, most of those components are going to come, from overseas, if not sourced from China, as an example. So that does put a threat. And just an area too that we just continue to see and try to understand where those exposures are.
Yeah, generally, if you remember, it's a little bit different than sometimes it's systematic inflation, where it's a consumption tax essentially on a particular good, meaning those dollars many times could go to a different type of good. So that's the interesting net impact on the economy is a little different than systematic inflation that is more of a, the supply chain issue and things like that we had a couple of years ago. And so there's the tariff impacted categories and then the other core goods. And generally there's certainly a one time at least price shock that will either have to be absorbed or passed on. And then generally what we saw last time in 2018 is then prices started to migrate kind of back to normal or come down a little bit from there. But again, a lot of unknowns just with where we'll sit on or where we'll end up landing with the China negotiations and some of the other ones, but China being the most important, I think, to most of these businesses, really.
Yep. And also watching sort of what is actually done versus what is said. I know it seems some comments sort of around let's call it more the social side of things. I think that's an area too where there's a lot of interest. It's an interesting time. Lawsuits in Columbia University and Harvard, for example, lawsuit against Maine. So just sort of understanding, it's just more about trying to, the midterms are going to be next, right? So is it about trying to get support from an existing base and maybe the impacts aren't as meaningful? In other words, companies just sort of figure out ways to do the same thing but call it something else. Like those are all kind of the things we all, I think, continue to monitor and just try to understand how much of it is sort of the noise and then how much is it really sort of the meaningful societal changes that are impacting all of us, and then on the sort of company level, those impacts as well.
Generally, we just need clarity more than anything. The market needs it. These companies need it. And I'm sure you need it as far as like you just need to know the rules of the game. And that's what's been challenging to get a handle on the last, couple months with this. So that's the hope over the next few months during this pause. We'll have much more clarity by the end of this 90-day pause of kind of what those rules are, because the, consumption, the business investment certainly does slow up meaningfully when there isn't that that clarity. So let's see. I don't see any others in the chat.
Yeah, I just have appreciate the opportunity to join you all today.
Yeah, thank you very much for having us. Again, I'll pass on some of the our trending conversations piece. I think that could help too. But if anybody thinks of anything offline, you can shoot me a note as well.
Cameron, Renee, thank you so much for taking the time today. We really appreciate it. And we will definitely distribute out any material out to everybody once we have it. Thank you so much.
Awesome. Thank you. Thanks a lot. See you later.
Thanks, fellas.